you're self-employed or a business owner, I'm going to tell you 4 things you probably should do and 1 thing you probably shouldn't do in order to save taxes for your business, yourself, and your family, and just put yourself in a better financial position. Number 1, contributing to a SEP IRA or solar 401k plan. Both a SEP IRA and a solar 401k are self-employed retirement plans. If your primary income is from being self-employed or having your own business, you don't have access to regular 401ks that W-2 employees have. So the government provides these couple of options in lieu of a regular 401k employee plan. But there's things to consider between if you're going to do one at all, or between choosing what self-employed plans are available to you. You have to look at how many employees you have, if you have employees, how much you have to put away. You can usually put away more with a 401k than you can with a SEP IRA. So you have to look at what kind of money you're making, how much cash you have to put aside before you choose what plan to do. And just because you have one year doesn't mean you can't do the other one a second. You can have a SEP IRA and a 401k and decide year to year which one makes sense for you. But again, you need to review things first, because over-contributing or contributing to this if you have employees and making a mistake on that can lead to big penalties and interest. For example, if you have employees, sometimes you have to contribute the same percentage for them as you do for yourself. The other thing you could do, which is great with these plans, is you don't have to do it by December 31st or April 15th. You can use profits earned in money earned in the next year, for example, money earned in 2025, to take a deduction on your 2024 return by simply filing an extension. So again, you want to set these up properly and look at your financial statements and talk to your accountant on a year-to-year basis and make sure everything's done by the right deadline, not violating employee labor laws, things like that. The second thing we talk about when we try to save money for our self-employed and business owner clients is hiring your children in your business. Now again, you got to look at different state and local laws, labor laws, how many hours your children can work, what things they can do for you. Again, they really have to actually be working for you, right? But by setting it up properly, you can not only take the deduction for the money you pay your children, but then you can also set up retirement accounts, most popular is the Roth IRA, and take that money you pay them, put part of it into a Roth IRA, not only getting the tax deduction, but having money grow tax-free for your kids' future, which is going to be invaluable to them when they get older and they get towards retirement. The third thing we're going to talk about when it comes to saving money for our self-employed and business owner clients is the Augusta Rule. Now, you have to own real estate generally to take advantage of the Augusta Rule. If you own real estate, whether it's your primary residence or a second home, your business can rent the real estate for 14 days or less from you and or your spouse, not only getting a deduction for your business, but also you don't have to pick up that income if it's less than 14 days. So you get kind of a double dip here. You get deducting an expense for your business and not picking up income. But again, it has to be planned properly, there has to be documents in place, legal agreements, because if the IRS audits this, which they do a lot, you can not only lose the deduction, but then face penalties and interest. The fourth thing you probably want to do at some point is review your corporate structure. Again, a lot has to do with what state or city you're in. Right now, what are you? Are you a sole proprietor? Are you an LLC? Are you an S Corp? Are you a C Corp? If you're an LLC, you can tax that as an S Corp or a C Corp or a partnership. So let's review that, review your numbers, what kind of profits you are earning now, what kind of profits you're estimating in the year ahead, where you're located, and are you set up as the right structure for the type of business you are, the state and city you're in, to maximize your savings on taxes. By changing your corporate structure and planning the right way, you could save thousands of dollars on your taxes. And the last thing, which you probably shouldn't do, is moving to another state or city just for terms of saving taxes on your business. Most small businesses are pass-through entities, right? You're either a sole proprietor, an LLC, taxes a partnership, an S Corp, a single member LLC. So by being a pass-through entity, your business is paying little to no taxes. So by just moving the business and not yourself personally, you're probably not going to save anything. If you're ready to make that personal move, right? If you're willing to, you and your family are willing to make that personal move, then of course you could save money on taxes. But if not, don't just move your business state just to save on taxes, because it probably won't do anything for you. It could even actually hurt you.